What's up, guys? This is Brian. Happy Thanksgiving. So, I've gotten a lot of feedback, and this is a really important concept that I've been sharing on Twitter, interviews, and a lot of times I'll refer people to this, but I've never made an official kind of video to put it all together. And I thought I would take this opportunity to make something once and for all. Everyone understands this concept, can apply it right away, and understand all of the nuances in an easy to digest format. So this is my official freezing guide, how to size up responsibly and treat trading as a business. Okay, so in this video, what you're going to learn is who's this for? Why would you do it? We're talking about the freezing method, something I've described plenty of times. It's something that I've developed to assist my trading progress from literally when I was trading a $30,000 account all the way up to trading, multiple, seven figures worth of profits. I wired out 90% of that ahead of a big drawdown, which is one of the big points. And I'm going to talk about that later in the video as well. Already you can tell basically that's been very, very important for me. And I can assume it will be pretty important for a lot of people because trading is a very unpredictable business. Thirdly, it's going to be about systematic wiring. A lot of times people will hear like, oh, wire out or, treat trading like a business or anything like that. But you'll come to find that a lot of times people actually cannot execute on that. They have psychological limitations of being greedy or being fearful that they're going to miss out if they take funds out. And generally speaking, have a lot of psychological issues surrounding this. So I believe systematizing it allows a person to make the right decisions despite how they feel. And for a lot of people, this is the right suggestion, in my opinion. And then fourth, we'll talk about how to manage sizing up and down and generally just growing your account through the R compounding process that I always talk about. Okay, so this video does require some prerequisite knowledge. Fortunately, I do have a video called R Compounding Multiples, and it really goes over the process of growing your risk day by day, compounding up and down. Just two very quick examples here. Let's just say your account size is 30,000, and we're going to be risking 1%. That means your R multiple will be $300. However, if we added 3R to the account, let's say we had a 3R day, then we would now be risking $309 as a result of, just growing the risk based on the account value. This also works to the downside. So we'll be downsizing if we took a minus 3R risk. And as you can see, the numbers did fluctuate quite a bit. However, it really remains to be seen because you're going to have to experience it for yourself to understand the true power and the consequences. So I want to just kind of talk a little bit about that, which is the risk oscillation, meaning your risk is going to go up and down quite a bit. Not only that, but compounding is such a force that your account, given the right conditions and your risk, can grow very rapidly. But the benefit as well is that you're going to be downsizing in a lot of cases when you're doing poorly. Growth is a double-edged sword. In a lot of cases, like I said, you can grow very quickly. However, growing too quickly can lead a lot of traders to making life-altering or game-breaking mistakes. I know this firsthand because as I was growing my account very quickly as a beginner, I lost control of my ability to manage the risk and also lost control of how much the money psychologically affected me in my trading execution. We want to be protected from yourself and the market. Essentially, by using our compounding, we're going to be in sync. And what I mean by synchronicity here is that when we're growing, we're going to be growing when the market conditions favor us, when our strategy favors us when the optimizations you've made to your strategy are working, and vice versa. When the market is not going against, or when the market's going against us, we're sizing down and we're protecting our, our gains, protecting our accounts. We're sizing down as our strategy is taking heat, which could potentially have a lesson in it, such as we're maybe getting too greedy, our strategy has some holes in it, or it could simply just be a number of factors, including you're just trading off, the market's not working for you, and in many situations such as this, you should be effectively sizing down. So just recognize that compounding, in my opinion, takes a lot of the guesswork out of sizing and allows one to focus on process, which I think is really, really important. Another piece of prerequisite knowledge is understanding your statistics. So I find that a lot of traders typically ignore or overrate certain statistics, such as, they'll go and look for the more complex stats, such as profit factor, or they'll look for like their Kelly ratios, or, all those like fancy terms. But in reality, the most important terms that I suggest to focus on are the average winning trade, average loss, win rate, and that's essentially it. Now, like, those three in combination really affect your ability to grow and can basically predict if you're going to make money in the long run or if you're going to lose money in the long run. So once you understand these statistics, actually real quickly, I would just suggest to upload to TraderView. It's free. Essentially just get some data, but more often than not, I would suggest to do it manually. It's more meticulous, but you're going to get more accurate information for yourself. That's what I do personally. But if you're lazy, there is a website you can use, and in reality, you should always have a grasp of these numbers. If you don't, then I would consider that basically running a business, but having no, books. You have no record of your transactions. You have no statistics on your sales, inventory, everything like that. Like, it's just you shouldn't even be in this game if you don't understand your statistics. Okay, so I want to talk about setting your position loss and daily max loss. These are two different things. A position loss is essentially how much you're going to lock out on a trade on any ticker. So that's really important. And the second one, which is even more important, is the daily max loss, which is just your position loss combined with your average amount of tickers you trade per day. This is something that you should scale given different opportunities. But the reason why we use averages is because typically you're going to fall within that and you won't have to make too many adjustments. However, let's just say, for example, one day that you're trading a extraordinary amount of tickers, then I would definitely, try to scale that max loss up and understand how to do this. All of this will be information that you can get with Google Sheets or Excel, and it should not come as a surprise to you how to extrapolate these numbers. But I do want to get into an example just to make sure you understand. So if your average winner is 2R and you multiply that by 2 tickers per day, basically that means that we should have a position max loss of less than or equal to 2R maximum, multiplied by the amount of tickers you trade per day, typically, which is 2, and that gives us a 4R daily max loss. So we take at least, or at most 2R, and then at most 4R for the daily max loss. This is when you no longer continue the trade. The rationale behind this is it's a little bit more nuanced than what I'm going to talk about, because I'm just trying to give you the basics to talk about the meat of the subject. But feel free to ask me about that on any Twitter or Discord or whatever. And just like I mentioned, Google Sheets, Excel, same thing. Do not be lazy. It only takes you like I don't know, you only need to set it up really one time and then just constantly update it per day. The reason why we use these is just to automate some of the process and create a system for it, because you're going to deal with a lot of odd lots like this as you're compounding. If you can multiply these numbers by 2, 3, 4 in your head, that's great. You're fantastic at math. However, when these numbers become 4-figure, 5-figure, or 6-figure numbers with a lot of different digits, I would reckon that it's not something that you could do in your head very quickly, let alone why would you even need to? All right, so what is freezing? Okay, first of all, freezing is basically for anyone who's growing the risk. And this starts from the very beginning. I don't care if you're starting a fresh account or if you're trading a 7-figure account. So long as your ambition to grow your risk is growing past a limit that you've never tested, freezing is very important. The idea of freezing essentially is to quantify your baseline R. And it works in a fashion where it's consistently growing with you or decreasing with you, just like we mentioned with the R compounding. However, there are going to be psychological and physical limits to your growth. And I think it's really important to understand that, because it's obvious when you watch, let's say, like a TikTok or a reel, and some trader is saying like, oh, if you compound your account 2% per day, then they'll start with some like very small amount of money, like $100, and then all of a sudden it'll be like $1 billion, right, in a year. And yeah, in a perfect world, that makes sense, where everything goes right. However, we have so many limitations in the market, such as liquidity, psychological reasons, like could you really risk $1 today and then tomorrow risk 100,000? Probably not. And lastly, it's obviously just marketing fodder to gain an audience. So the truth is, freezing is extremely important, and I'll show you exactly kind of how I do this. So once you understand your revolving baseline R, basically if you use 1% or 2% of your account or whatever like that, that would be your baseline R that would constantly grow with your account size. Doesn't matter what it is, what your account size is, it will constantly move with it. So the first two things we want to identify is the soft target and the hard target. These are determined not in a systematic way, but mostly logical, psychological, and also intuitively. So I'll give you some examples here. So basically, let's say your R is $100 and you're trying to grow it to the freezing levels, essentially you'd set a soft target and a hard target. So the purpose of this is to set different checkpoints where you're going to actually use this process and also evaluate yourself. So soft targets would be examples of like $125, $150. So essentially what you would say is, okay, once I grow to the $125, I'm going to check in with myself, make sure that I can risk without any hesitation. My execution is solid. And, I might need to take a pause here if I'm starting to get sloppy. If not, I can probably move forward. If 125 doesn't seem big enough to you, you might say 150. And in parentheses, I put the percentage growth just to make sure you understand how it scales, because I think people consistently over-evaluate or overestimate their ability, and these percentages will help you understand. So let's move to the hard target. So the hard target essentially is like your goal. Like if you hit that, you'll be pretty happy at this point in time. So if you're at $100 base and you manage to get to $200, psychologically, that's a pretty big difference. I mean, from 100 to 200 risk, let's say if you're making like 2 to 3 R per trade, that's like a $400 trade or a $600 trade. This is a 100% growth, and it's a totally valid hard target in my opinion. But I feel like a lot of times people will go even further. So let's say you try to get to $300 or $500. The problem with this is that if you go for these bigger risks, like you can see the account or the percentage growth, it's quite big. I feel like you're skipping steps, and this is not really the case of hard target. I mean, in reality, okay, if it's a perfect world and I was just being completely facetious, I would say, okay, well then why not your hard target just be $1 million risk then? Well, the problem is you would never hit it. And these, again, are checkpoints. So it's really important that you actually, view these as important milestones, because we're going to constantly evaluate ourselves here and keep moving the goalpost. We're not saying this is the end all be all. And we're not saying that you have to spend a lot of time here if you're continuing to execute well. We're going to go through that in the next slide, but just keep on track with me. Okay, so let's further extrapolate this to bigger numbers. So let's say, for example, now we're risking $2,000 baseline. You can see how if I set a hard target at 2,500, that's just a 25% gain. Now, while that might seem like a big number, it's actually much more achievable than, let's say, $3,000, which is a 50% gain, or $4,000, which is a 100% gain on your R, which I would say is a pretty good hard target at this point, despite the fact that it seems like a pretty big leap. It's actually more aligned with the previous hard target with the purple. And then let's say, for example, if you said, I'm going to go from 2,000 risk to 5,000, well, that's a 250% gain. So all I'm trying to point out is like the numbers can kind of play with your mind, especially as you're at the smaller numbers and the bigger numbers. Sometimes it helps to put them in terms of percentage, so you yourself understand if you're overestimating yourself or underestimating your ability as well. I also have been talking about this a little bit, but I'm going to further elaborate. So the incorrect application would essentially be setting outlandish targets that you would love to have for your ego, but are not necessarily logical leaps, and that you may never actually hit in a due time. The goal is to set these levels that you can check in with yourself and constantly evaluate whether you need to move the goalpost. And essentially what I will do is at each level, if I can maintain my execution, I can feel nothing about the risk, then I may move forward. Or if it's the opposite, where I feel kind of uneasy, I'm not executing that well, then I might sit at that level for different amount of times. And this is essentially what freezing is. So let's just say, for example, I doubled my risk, and now I feel a little bit uneasy. Then I might spend a day with it. Let's say it's $200, or maybe a week, or maybe 2 weeks. But let's say more significant milestones, like eventually I do break that barrier, and I've moved on from $100 risk to $500 risk. $500 to me, and probably to a lot of people, especially because your trades can potentially become 4-figure trades now, like $1,000, is a more meaningful, more psychologically impactful. I might suggest, or you might feel that you need to spend a month at that level to get used to it, or an even greater amount of time. There have been risk levels where I only felt like I needed a day, a week. And there have been even bigger levels where I figured that I need actually 2 or 3 months. And that's totally okay. You set the bar, but you should understand kind of how you feel about it. You should understand if you're executing well. And also, one more thing to anticipate is whether the cycle is just too favorable. So let's say, for example, things are just going well overall. You can't really miss. Everything is working. You can't underestimate the fact that like things are just going well for you. So what I like to do in a lot of situations with hard targets is to let myself experience first drawdowns or experience a loss, like a daily max loss, experience a hard cycle, just to really be tested and make sure that I'm actually completing this checkpoint and moving forward responsibly. This is totally up to you again. However, I would really suggest growing with all of these things in mind. And one of the things that I really like to do is think about whether this money would be meaningful for me. Like, does this represent a month's worth of rent, month's worth of expenses? Is this the equivalent of, let's say, a car or a PlayStation or a computer or, whatever? If it means anything to you at all, that's a good sign that you probably need to spend more time with it. The true way to move past hard targets is basically by being, okay, I don't care if I win or lose. I don't care if I max loss. I don't even care if I lose for 2 days or 3 days in a row. Max loss. It should not affect any aspect of you. You should be completely used to the numbers. If someone handed you that money, you wouldn't really be affected. If someone just gave you $1,000, if you lost $1,000, like if someone just took that away from you as well from your bank account, you wouldn't care. Like, all of these things need to matter. And the last point I want to make is when you do wire, and that's the second component of freezing that we'll talk about next, when that money hits your account, if that doesn't spark any emotion of like over happiness or anything like this, or exuberance, and it's just another paycheck, then that's the way to recognize, okay, I'm getting used to this, like I deserve it. Psychologically, you understand, okay, if I deserve this money and I fully accept it, then I'm ready to move on. Okay, so here's the wiring component. There's called wiring thresholds and buffers. It's much more simpler than it sounds, but it's key to this process. So let's just say, for example, you grew your account from 45,000 to 50,000, and your R baseline grew from 450 to 500 at 1%. So what we need to do is we need to create a threshold. So essentially, if you're trying to risk $500 and that was your hard target, then that means your account only needs to be 50,000. So essentially, what the threshold says is if we're, making a profit, let's say we got 52,000. Well, that's the number I use in this example, so I'll use a different number. Let's just say we grew 53,500, anything like that. Then we'll just wire out, because since our R is not technically growing and we're just freezing at that level and re-risking that over and over again until we get used to it, then all of that excess we can return to our business accounts or to our bank accounts. That's what triggers the wiring phenomenon. However, if we stayed exactly at 50,000, then any little removal from the account, any loss would essentially like take you down from the risk, which is not what we want. We want to basically inoculate ourselves to the risk as much as possible while we can. And that means maintaining kind of like our range within this buffer. So the buffer is essentially this calculation that we did before. So all we're doing is we're just adding a max loss to whatever account size we have. So if our 2R times 2R position max loss times 2 average tickers is 4R, that means it's $500 times 4 is 2,000. So therefore, we would add 2,000 to our account balance to give us a 52,000 threshold. The purpose of this is if you sit at 52,000 rather than 50, even if you take a daily max loss, you'll still return the next day risking 500. And therefore, you're still practicing and again, inoculating yourself to the risk and like getting the reps in that you need. Well, let's say that you are losing because whatever reason, like either the market or you're just not handling it very well, as you might with hard targets. It's always different. Again, $500 might not mean much to you, but again, this is a practice that I've done like well into the I want to say like mid 5 figures range. So it might be different risking like 20,000 or 30,000 or 50,000 versus risking 1,000 or 500. So take that keep that in mind as well. But essentially, like you're going to be deleveraging on your losses through the R compounding process. So let's say, for example, you drop beneath 50,000, then your R should be decreasing as well. The only time, so all you're doing is you're just ping-ponging and the R compounding, but only to the downside. Your max risk is capped, so you don't grow past your limit without meeting all the necessary psychological thresholds. And then once you grow back to that threshold of 52,000, then you start wiring out again the same way that I mentioned. So if your account grew to 54, you just wire out 2,000, and then that way you're consistently going to keep adding these wires up. And much like the compounding process, you might think, well, it's a small amount, but when you do this consistently, it just adds up to an insane amount of money that, again, I think you're going to have to experience it first to really understand it. I'm just giving you the guidelines, but again, no matter how much I explain it to you, unless you really commit and do it yourself, you're not going to experience the sensation that I'm talking about. And it's a very amazing feeling, to be honest, and it's hugely motivating. So again, the purpose of this buffer is to make sure that you're spending as much time responsibly with your hard target as you need, and that you don't feel super attached to the outcome of the day, because you might feel like, oh, I'm not going to risk 500 if I'm just risking 50,000, I lose. So you might execute a little bit differently. You want to eliminate a lot of those factors as much as possible. Okay, so at this point, rinse, repeat, trust the process. We want to treat trading as a business. It is very volatile. What I mean by that is there's going to be periods in time, like in my experience, there's been weeks where I haven't wired, or months even, 2-3 months. And there are going to be months or weeks where you wire out like every single day or every single week. And that's a good thing. I mean, you want to experience the market as it is. Not every single month is going to be the best month of your life or the worst month of your life. It's going to be up and down, and you just don't know. So you want to use this process to take advantage of the good times, so that when you do go through those valleys, that you understand, okay, I have savings, I have the resources to weather the storm, and I also basically can learn from these opportunities, and do so responsibly, basically. You know that you're sizing down when you're drawing down, and you know that you're growing your risk as things start to work again. And that can be for many reasons again. So that could be because you're performing well, you made a good adjustment to your process, or that the market just simply is going in your favor. So there are a lot of reasons why, but typically when you go through drawdowns of any kind, there's usually a lesson there. So you shouldn't, in fact, be wiring out when you're basically just trying to learn a lesson. You should just trust the R compounding process. It's a beautiful process, and just go through it. The other aspect of wiring out is risk of ruin. So all too often, people's whole net worth gets locked up in trading because there's an exponential amount of money being made relative to their prior profession. And so people, or simply that a lot of people's net worth is required to open up accounts in general. So whatever it is, essentially you want to reduce the amount of your net worth linked to your account so that you can focus on process, and also, take distributions in the sense of like wiring out and pulling money out of the market consistently to further widen that gap. Because as you wire out more and more, and the less the account means to you, the more you can grow the account without being emotionally tied to it, and also basically protecting yourself from the downside. Because what can happen is essentially all the money in your account is liable to being lost. And if you need any good examples, you can always look at some of the black swans like ZJYL, TNON, or more recently PGHL, which are stocks that did things that no one thought was possible. And literally in one trade, you could lose everything. Now, if your account is capped, that can help quite a bit. But even more so, obviously short sellers can lose infinite, but even more so what it does is reducing your R value based on net worth, so that instead of representing, 1% of your net worth or 2% of your net worth, that R value is, becoming less and less, like, any number under 1%, it becomes very small numbers, right? And then when you lose multiples on that, it's not going to kill you. You can rework from that. You can still execute your skills to grow your account. It's just sometimes things happen for no damn good reason in the market, and you just have to be prepared for that. If you put all your eggs in one basket, effectively you're saying to yourself, like, I'm in a game where anything can happen, especially in terms of fat tail risk, and I'm comfortable being willing to lose everything. And if that's okay with you, then definitely just continue what you're doing and ignore this video. But if you recognize the reality about trading, like I do and I've seen, then you'd be wise to listen. And then lastly, by consistently wiring out, you're going to be buying yourself time. You want to start thinking and quantifying your months in terms of expenses. So let's say, for example, your mortgage or your rent is, $2,000 or something like that a month. And then you have, groceries and other sort of expenses like subscriptions or whatever. Like, really tally that up. Make sure you have a good grasp of how much you're cash flowing in and also cash flowing out. Or I don't even know if that's the right way to say it, but basically what's coming out of your accounts, right? And you want to make sure that you understand, okay, I have a month worth, then I shouldn't be necessarily trying to grow my risk like crazy. I should actually be trying to pull out of the market to grow that timeline. Now, like, if you can get yourself to a year or multiple years, or even just a couple of months, just like these small caps, it's like sometimes they have like a month left of cash. Do you think that they should be risking it all? They're going to need to raise capital, or they're going to need to do other things, right? But if you have a company that's got 12 months of cash, then they're probably going to be able to uptrend and make new highs and stuff like that, because that's the least of their concerns. And that's kind of what you want to embody in a way. That might not be the best example, but it just came to mind. And essentially, the more time that you have, the more that you wire, the more that you think about it in this way, the more that you're going to be able to execute and, again, treat trading as a business that it is, a volatile and ruthless business where the ups are very high and the downs are extremely low. When you're able to effectively weather the drawdowns and the valleys and learn from them without placing a ton of pressure on yourself or being negatively affected by all the emotions, that's when I would consider you a true professional trader. You need to be able to wield compounding as a weapon versus as a force of nature. So compounding can be described in a lot of ways. People will say that it is one of the most amazing phenomenons. It's something that, over time, it's a weapon, But what a lot of times happens is people who don't understand compounding and how to size up and size down properly, for them, it's just a force of nature. It's something they can't control. And the thing is, when you can't control compounding, no matter what you do, it can affect you negatively. It can bite you in the ass if you don't harness it properly because of the absolute nature of drawdowns. And if you grow your account again, I keep saying again, but even if you grow your account from 100,000 to 100 million, when you do take a big drawdown, which will happen at some point, it's going to be a big problem. Because if you lose 50% of your account at one point at 10 million, it doesn't matter how much you've gone to that point. You're going to have to make 100% to make it back and so forth. And so basically all this is meant to further that divide, to eliminate the aspect of risk of ruin, to create the ability to treat this as a business, to be successful in like managing your emotions, to be successful in growing your risk responsibly. And essentially, like what I would say is, if you manage to master each and every level, it's kind of like building out a really strong foundation for yourself, versus if you just kind of blitz through the process through compounding and you get your risk very high. The problem is, like, because you haven't mastered any of those prior levels, it's kind of like a house of cards. The moment it starts unraveling, you're just going to be like unable to manage your emotions at any point of distress or any point of negativity, and you're just going to crumble. If you can master each and every level and emotionally resonate with all of it, you're going to be able to find some very positive and enlightening moments throughout your journey. And you're going to have a lot of trust in yourself and in the process. I guarantee that. So here's a little bit of extra tech. If you happen to be in a deep drawdown, then we're going to use a different process, which is my outlier days process of wiring out 50%. Or if you're capping your risk. So if you cap your risk, and this is a final capping, this is not like a hard target. So let's just say, for example, like if you max out the liquidity of small caps, you may not want to risk more just because it doesn't even make physical sense. And so you'll need a mechanism to start wiring out, apart from using a threshold, because it's just way more consistent at this point. The freezing method is if you desire to grow your risk and you need to psychologically come to terms with everything. So what's a deep drawdown? I consider that like a deep cut. Let's say, for example, you had like a black swan, or you had a big ass loss for some reason, and now all of a sudden you're very far from your targets, and you know and anticipate it might take a lot longer than you normally do to recover that. Or if it's a prolonged period where you think you might not be wearing out for like 2-3 months minimum. Sometimes you don't wear out for 1 to 2 months, or sometimes 3 months, and that's okay. But like if you can anticipate a very long period, then I would start doing this method along the way. So basically I would wire out 50% of outlier days, despite the fact that you're in a drawdown, you feel like you're slowing down your progress. I gave my Traders for Cause presentation about this year in 2024. But since I know a lot of people haven't been able to watch that, I'm going to just mention again that freezing has a blind spot. It's when you go into a drawdown, and just like I did in 2022, and where you feel already comfortable with all the levels of risk because you've mastered them. So as you're climbing back up, you never feel like you should wire. You also feel like any wire you do is going to slow you down. And what that can do is that can throw you into this loop where you're like constantly gaining and constantly losing and falling for this geometric losses, compounded losses kind of thing I was talking about with the percent drawdowns, where you're never quite wiring out of the market, and effectively like your emotions get really tied up into trading, and it's a big mistake. Like even if you're in a drawdown, literally the moment that I started wiring again is the moment I start recovering from my drawdown. It took me like a year to learn my lesson, literally. I honestly believe if I started wiring again, like within a month of when I started going to drawdown, I would be in a completely different situation. So take it as a lesson from me. And if you don't believe me, that's okay. But for those that do, like, take it from me, it's a very big blind spot in the method because it was designed for growth, but not like deep drawdown. And I would consider outlier days like anywhere between 0 and 5 times a month. You don't want it to wire out every single day. That will slow things down. But if you're wiring out 1, 2, or 5 times like perfect month, you won't really slow down your compounding that much. Like you just have to trust me on this one. You can do the math as well. But what this does is it prevents you from like growing your risk too rapidly especially when you already know all the levels. So you do want to cap that a bit. And the reason why is because markets kind of cycle and things cycle as well. Emotions cycle as well in terms of like your exuberance and all of this. So, typically if you have like an amazing day, it can be followed by some pretty harsh and humbling days as well. I've experienced that, over 8 years of trading so far. Like it happens a lot. You can have a big day and then all of a sudden you have a big loss the next day because it's not because of, you might not necessarily done anything wrong. It's just that your risk has grown so rapidly that it actually affects you quite negatively. You can grow your risk very quickly with the compounding, especially as your skills grow. And as a more advanced trader where your gains can be quite big, you do want to limit the amount of exposure you're putting back in. And secondly, just ask yourself, you don't even have to listen to me, but just go look back at your calendar. Find like your biggest winning days and ask yourself like how much you would have made from wiring out 50% of those and how much you would have saved in the following days if you had done so. Because a lot of times when people are all winning, there's going to be like a balancing. That's just how markets work. If one side consistently won all the time, then I wouldn't even be making videos because I would just be on my yacht somewhere. And so would everyone else. We would all just be in a Maldives or something together, Monaco. But the reality is like the markets self-regulate where all of a sudden, all the short sellers are going amazing. And then there's a big ass black swan, everyone gets blown up. Or all the longs are having the most amazing ride of their life, buying every single stock. And then all of a sudden, all the stocks are just collapsing once all the music ends, This is the way the markets work. And so you just have to be in sync with that and adjust your mentality to say, hey, I'm treating trading as a business. I'm taking money out and putting it into my account. Like that is the purpose of me trading. And for most people, this is going to save you so much grief and it's going to empower your trading because you're going to be able to detach yourself emotionally from the markets and from losses and from everything. That's really the goal, is to have the perfect, strive for the perfect psychology in trading. It's just very, very important. This is a very simple system that I developed with one of my friends, but it turns out Livermore agrees. Here's a quote. So this is the book Lessons from the Greatest Stock Traders of All Time. And the quote is, "Another discipline Livermore started later, and if he had done so sooner, would have helped him avoid some of his lowest moments, would be to take half of his profits, usually on trades where he doubled his money, and put them in a cash reserve. This reserve would serve him well in avoiding bankruptcy. It also supplied needed capital when the market would turn, and he could use it to take advantage of changing market situations." Absolutely, absolutely. Make sure that you understand it's not just something that, Brian Lee from Twitter made up, but, Jesse Livermore, we all can look up to him. We all understand his impact on the trading world. And, there you go. So final words is James Clear quote. He said, "It's a hallmark of any compounding process. The most powerful outcomes are delayed." So what happens is a lot of people, they can hear me say it 1,000 times, but until you actually do it for yourself and see over time what happens, then you will come to appreciate what I'm sharing. And it's not something that you're going to see right away. However, if you do trust me and you commit to the process, then you will see some amazing results, like a lot of people that I've been helping recently have seen. And we've had a lot of discussions about this where people are finally starting to say, hey, I'm starting to see it myself. I'm seeing it with my own eyes. I'm starting to feel it. I'm starting to experience it. And it's amazing. And they know, they understand what can happen if you follow this process. All right. So I'm just going to do you can end the video here if you're not interested, but I'm just going to do some self-promoting. So for anyone who just wants to listen, basically, I have a Discord server. It's in the link in the description. So there's 3 different tiers. It's Spark. So Spark essentially is a help yourself. It was the main tier of my Discord in the past, and there's a lot of good conversations and information there. However, in order to limit the amount of work I need to do and spend less time on this project, it's essentially an archive that you can Google basically any question you want, like search up there and say, hey, if I want to learn about risk management today, I want to learn about systems today. You can find so many good conversations, and that's the reason why I keep it up. That one, you can do a free trial for 7 days and essentially just look up all the questions you want and save all the videos and stuff like that, and learn quite a bit for nothing. Okay. Secondly, there's Blaze, which is like everyone is going to get a webinar every month, which is really, really important for understanding cycles, themes, and really getting immersed in this world of trading and small caps. And there you can I give you permission to send me messages on Twitter or on Discord, and I can help you out in a more individualized manner. And then lastly, there's a Blaze Plus, which is the link I'll also put in the description from LaunchPass, and essentially that will cover all of that. So you get access to Spark and Blaze, and I offer one-on-one coaching there that you can schedule, and we can meet up once a month. And that's if you need more individual attention. I just provide that option, and yeah, enjoy that. And then the last thing is just my broker. So recently my broker started opening up, and I've been inviting more people, giving them really good rates and giving them really good commissions. Essentially, you coming in as a newbie would get the rate that I got. Not even you'd get a better or equal rate to what I got as being the highest volume trader at Guardian in 2021, which you can imagine is a lot of phenomenal traders trade there, but trading the highest volume is what matters most to brokers, seeing as if you have lower volume, you're going to get higher fees. If you have higher volume, you're going to have the lowest fees. So essentially I had the best fees possible, and you can get that literally joining on day one to my broker. So we also did comparisons where we're seeing amongst the big brokers, we're essentially number one on all fees. We're 25% of essentially everyone. And if you're interested, send me a message and go through me, and I'll make sure that you get a really great deal, and you won't regret it, especially since it's one I've been working with for 3 years now. And I just don't see myself going anywhere else at this point. I'm there for life. So, a lot of people have been enjoying it, especially from the server. And I just want to open that up a little bit more. So let me know. Okay, finally, just thanks for watching, guys. Thanks for getting through to this point. Let me do some self-promotion. And happy Thanksgiving as well. Hope to see you guys. And I hope to hear more stories from you guys succeeding at some of and learning from what I've been sharing. So thanks.